Today, 80% of businesses don't sell. To be a part of the 20% that do, and at maximum value, you'll need a successful strategy. Welcome to the Defenders of Business Value podcast, where we interview today's top professional advisors who help business owners create, preserve, and most importantly, transfer value. If you want actionable tips that will increase your business value, stay tuned. The podcast starts now with your host, Ed Mysogland.
My name is Ed Mysogland. I'm the managing partner here at Indiana Business Advisors, and today we're going to talk a little bit about deal killers. We'll get started with a couple housekeeping items. Number one, if you are unable to get through the presentation, don't worry, we'll send that out to you. In the event that there's technical difficulties, again, no problem. We will send the video and the audio. Even if we have to re-record it, we'll get it to you. So today we're going to talk about deal killers. And so what we did was we compiled roughly 13 different deal killers that we normally run into. And this certainly is not all inclusive, but these are the most frequent ones we see. I would imagine we're probably going to go for about a half hour. So if you have any questions or anything that you want to make sure that we cover, Chelsea is manning the chat box, so we will she'll get those questions over to me. So why don't we get started? Our first deal killer is valuation. The interesting thing about valuation is that it represents about 40% of the reasons deals don't go together. So if you think of the number of transactions as a pie chart, roughly 40% fall apart because of value, 40% fall apart due to emotional or other reasons other than financial, and then 20% cause the deal to fall apart for a variety of different reasons, and it can be literally just about anything. And I'm proud to say that we just surpassed our 2,100th transaction. So we've done a lot of these things, and I can tell you we have seen an awful lot of weird things that happen to transactions, and maybe one day we'll augment one of our presentations with just kind of the weird things that we've seen. So like I said, that's valuation. Now, unrealistic seller expectations. Now, the funny thing when we're working with sellers, the sale process is an emotional process. I mean, we get into situations where the seller can't let go of the business. There's an identification that they have, and they're unable to let go. And as a result, what normally happens is that the seller tends to have expectations from the buyer, either through terms or price or structure, that they were unable to bridge that gap. And so that's part of the unrealistic expectations. The other side is that the seller tends to focus only on the top line. And when I say the top line, what is the total value? From our standpoint, it's great that you get a 5 multiple. From our standpoint, as advocates for the deal, we're looking for how much did you put in your pocket. So it's nice to talk about the top line, but I'm more interested in what goes in someone's back pocket. And you'd be surprised at how many business owners that get tripped up with, I need this number. Well, that's not the gross number is not the one we want to focus on. We want to focus on what goes in someone's pocket. Our second one, and this is a tough one because you have to have a deal team. And I'll just give you my first example is attorneys. And love attorneys, but at times they're challenging from the standpoint of, like, we have a attorney that's a family friend of a seller. He has never done any kind of transaction work whatsoever, yet he wants to represent his family friend. And there's nothing wrong with that up until the part where we need somebody that has done deals before, because reauthoring or trying to get up to speed on the nuances of transaction work is an entirely different animal than, in this case, divorce work. So we have to work with both accountants and attorneys that have done deals before. And again, and for those of you that are going at it alone or thinking about selling your company by yourself without any kind of representation, and if you need an attorney, just holler at us. We've got probably 10, 15 attorneys that are our go-to people that we're happy to share with you. The other thing is, the other advisor is obviously from a brokerage standpoint. We have a little bit of a bias because obviously we believe that you should never go into a transaction by yourself. I think every deal needs representation. And so we believe that you need to vet and understand who's going to represent you in the sale process. And the biggest reason we always say is, number one, we have so many buyers that we're working with, and we'll talk a little bit about buyers here in a second, but when we work with buyers, we're creating a form that is you can't, as an individual, do. We have reach into the individual buyer pool, strategic buyer pool, and then private equity buyer pool. Not many people can do that by themselves. And so not only that, but we also tend to take the emotion out of the transaction. And that's really one of and I alluded to that in the previous slide, that's a real challenge that business sellers just don't understand. So got to have a good attorney, good accountant, transaction related, as well as you need some representation to represent your deal. The next deal killer is that the seller tends to take their eye off the ball. So we talk a lot to our sellers that this is a long process. And when I say long process, statistically, and new statistics just came out, that the average time to sell a company is roughly 9 months. So you can see that there's 3 quarters that go through those 9 months. And what happens is we see business owners that make the decision to sell. They show up at our doorstep, we're ready to sell, and they've essentially emotionally checked out. They take their foot off the gas. They don't do the things that they were doing. And as a result, performance decreases. And then all of a sudden, they're turning to us saying, well, why is the buyer renegotiating? Well, from the buyer's perspective, they're looking at the deal and saying, well, maybe this isn't what we thought it was. And as a result, we need to mitigate our risk. So that's what taking your eye off the ball will do. So normally what happens is we always advise our clients, operate as if we're going to be unsuccessful. That is the safest play that you can possibly make. So that's taking your eye off the ball. This one is a tough one because it is a long sale process, and especially if those that are are approaching retirement. I mean, they take it up to that wall, and then they've made the decision to sell, and it's hard to keep going once you've emotionally checked out of the business. Our next one is that the parties are not legitimate. And what does that mean? So from the buy side, we go through roughly 25 buyers to get to one good buyer, and then from there, then that buyer gets the opportunity to see the deal. They execute confidentiality agreements, produce evidence of financial capability, but we have to burn through 25 buyers that aren't right for the deal. So, and the reason I share that is those 24 buyers, some are perennial tire kickers. They just can't pull the trigger. Some just, they like looking at deals. It's funny when we look at some of our inbound website traffic on the buy side, you can see, from 11 to 2 in the morning, people are sitting there surfing the internet and saying, I don't want to go to work tomorrow. I want to go buy my own business. I want to go do my thing. And so it's interesting that we see that. So we run into a lot of buyers that just aren't legitimate. And at the same time, there's sellers that aren't legitimate. Regretfully, we've had a couple situations over the years where a seller has wanted to enter into the sale process, and they're not interested in selling. They're trying to buy time with partners or creditors, and there's internal issues there that are forcing the seller to act in that way, and as a result, they're illegitimate, and we can't do anything with them. So obviously, from a brokerage standpoint, we're pretty good at sniffing that out of why is this seller selling, and is there any duress or anything like that we have to be sensitive to. And so, like I said, for those of you that are advisors or business owners, I mean, you have, though, specifically on the sell side, you have to get that in order. Okay, our next one is corporate culture issues. This is becoming more and more prevalent, and everybody hears the word culture and how are people going to play together. Well, I can tell you, if it's company buying company and there's a merger going on, statistically speaking, I saw this and it floored me that roughly 80% of mergers are failed because they can't get the corporate cultures to merge. Financially, operationally, everything works, but one company has summer hours where we check out at noon. Others, we're grinding it out 9 to 5, day in and day out, and it just doesn't merge that way. So when the buyer is evaluating the seller's business, I mean, that's part of what they're evaluating, and it's just that they tend to, it raises a red flag if a particular business is just operating in a fashion that they can't see themselves being able to absorb or assimilate into their own business. So that's the corporate cultures. This is a real good one. The improper accounting, like just accounting in general. So let's talk a little bit about that. Look, we've seen financial statements in every kind of condition imaginable. And at the end of the day, we have to be able to, it has to vet out. And when I say vet out, I'm referring to we have to be able to survive due diligence. If not, we can't. It's useless to go to the market. So when we're looking at deals, we're looking at, okay, here's the financials you've provided. Maybe they're internal, QuickBooks or Peachtree. I guess Peachtree is no longer, but QuickBooks or any kind of internally prepared documentation, those have to reconcile. And when I say reconcile, they have to reconcile to the tax returns. Because if you're going SBA financing, for example, you have to be able to, those tax returns are what everyone's basing it off of. So we need our financial statements to reconcile to our tax return. Now, going back the other way, we have to have our deposits to reconcile to our financial statements reconcile to the accounting financial statements, the compilations or reviewed financials, and then into the tax return. We have to do that. Now, we run into a lot of business owners that, and this isn't condemnation by any means, but they're sheltering as much income as they can through their operating expenses, and that's fine. We just have to be able to pull it out and reference it. That, okay, and for example, I was reviewing a company this morning. They've got $25,000 that is auto-related expense for their kids, his wife, and summer home. Mobile home, that is, and so they're expensing all of that through there, and that's fine. But when we go to sell, we just have to be able to extract that out, so the buyer can see, oh, this is how much additional cash flow I have. And if you remember from previous sessions, we talked about how to determine our adjusted cash flow, and that cash flow has to answer 3 easy questions. How much can I pay myself or someone to run the business? How much debt can I service? And lastly, how much of a return of and on my investment can I get? And the accounting records all flow into that. Okay. Next, number 7, not planning enough in advance. This is a tough one. And I say that from a planning standpoint. So I do a lot of pre-sale work, and I can tell you that the people that come into our shop that are interested in kind of evaluating where they are from a value standpoint, where they are from an emotional standpoint, and especially the baby boomers, what are they going to retire to? All those things, we're having those conversations. And I can tell you from our standpoint, roughly 80% of those companies that do value work or pre-sale work and understand the advanced planning portion of the program, they have about an 80% chance of selling. Conversely, those that just show up and say, look, I want to sell, away we go. I mean, there's probably, well, I don't say probably, our statistics are roughly 30-35% success ratio. So you can see that being prepared is considerably better than just all of a sudden one day I want to go sell, and I want to sell for my value. The other thing that we have to consider with the planning is a lot of business owners are trying to, this is statistically speaking, roughly 60 to 90% of a business owner's net worth is tied up in the business. So you can imagine that the degree of importance that it is that they're able to sell the company and create that liquidity so that they can go on to the whatever the next step in their life is, whether that's retirement or buying another company or just doing what they do. So what we have to consider on this is, or as the seller is doing that planning, chances are they'll end up with their financial planner, and they're going to say to the financial planner, here's what we've been taking. Financial planner is going to say, well, if you want to keep that standard of living, you're going to have to sell your company for that. Well, unfortunately, there's just no correlation between the two. And the good news is that financial planners are becoming more astute, and either they're engaging us from a value standpoint, or they're engaging someone to get a better idea of value, because income replacement value, and that's a fictitious term, but that is often what we're seeing is that, look, this is how much I need to retire. And from a value standpoint, there's no correlation. The seller does not fully understand and articulate what the value is to the buyer. So there's two groups of buyers. We have our individual buyers, and we have our strategic or synergistic type buyers. Our individual buyers, they're essentially buying a job. So it's what their value is what's the likelihood that the income that you're generating is going to transfer to me. That's what an individual buyer's is looking at from a value standpoint. From a synergistic buyer standpoint, it's where are my synergies? And what does that mean? So when we're working with our sellers, especially the larger sellers, we're trying to identify what are the strategic attributes of the company. What would cause this business to be sold at a higher multiple because we're able to identify synergies. And the synergies may be market, geographic market, could be people, could be back room, it could be economies of scale through various suppliers and customers, cross-selling opportunities. That's what we're looking at. And so what we're trying to do, the reason it's a deal killer is that it's not adequately articulated, that this is why you should buy this company. So when we're dealing with buyers, on the individual side, we're looking at it from the standpoint of, look, this is how much money you can make, this is how you can pay your debt, and this is the return on investment. You will accumulate wealth quicker through owning companies than you will in the stock market. Conversely, we move over to the synergistic buyers. We're talking about, here is why the business is worth this to you. And when we start the dialogue between buyer and seller, and we start identifying the synergies, then we can advise our clients, and we're able to identify, if this happens, then this should be the premium. So, at any rate, the deal killer is that those kinds of things are not adequately articulated to the buyer, and the buyer will walk. There's too much information out there that says, mitigate your risk. Buyers are not crazy risk takers that they were a decade ago. There's just been, there's been a recession. There's just different mentality that you have to be sensitive to. Number 9, company-specific risks. These are the normal ones. In my world, this is called company-specific risks, and we're trying to identify dependencies of customers, suppliers, employees. For example, if Joe walks out the back door, are you dead in the water? Are there any lawsuits? Is there new competition coming in? We have to be able to identify that. And what happens is, especially those that go at it alone and then show up at our doorstep, they're sitting there saying, I don't know what happened. We got into due diligence and then it all fell apart. Well, those are the things that we're talking about, is that you have to identify what the company is dependent upon and offset that with how is the buyer going to mitigate that risk? Is that in purchase price? Is that in structure? What's going to happen? And that's normally where the buzzsaw is that the sellers don't know what to do. And so that's how we address it. We have to understand what is the risk to the buyer. So going forward, we understand that this is how the buyer is going to look at the business. Next, purchase price allocation. So every sale, there is a document that the IRS requires you to complete. It's Form 8594, the allocation of purchase price. The funny thing is, and don't hold me to this one, I was recently at a seminar that says buyer and seller don't have to agree to it. But after 28 years, every time it is a condition of sale. So the allocation of purchase price. So the buyer and the seller, this affects their respective taxes. Okay, so from a buy side, the buyer wants to maximize, and this is just an example, wants to maximize how much of the purchase price is allocated to the tangible assets. And the reason being is that they get the tax benefit of depreciation going forward. Conversely, the seller wants as little as can be attributed to tangible assets. Why? Because they've been doing what the buyer wants to do. They've been taking this depreciation expense, and then they're going to get hit with depreciation recapture. And then they're going to be taxed on that. And that's, like I said at the very beginning, it's a matter of how much are you putting in your pocket, not what is your gross. So the allocation of purchase price always is the buzzsaw. But if you happen to go to Form 8594 and look, you won't see anything that has buyer and seller signing it. So my tax accountant friend says, it just runs the risk of the audit. If you guys can put whatever you want, and this is him talking, not me. You can put whatever you want on it, but just be sensitive to that they may audit this allocation, and you may have to pay that depreciation recapture if you minimize it and too much. All right, next one. Stock versus asset. So the buyer and every advisor will want a buyer the safest bet is an asset sale. There's a stopgap. And so any contingent liabilities that follow the stock, there's a moat between the buyer and seller. So essentially it is a sale where the seller is just selling assets to the buyer, the tangible and intangible assets. So if any recourse, like any warranty issues or challenges like that, stay with the stock and the seller has to handle it. Conversely, the seller is saying, I want to sell the stock because it puts me into a better position from a tax standpoint, right? So it's just gain for them, and they take everything. I'm going to run my cash down, but you can have everything. And the problem is, like I said, the biggest issue is contingent liabilities. So often we run into the situation where the seller wants stock sales, buyer wants asset sales, and somehow we have to get to common ground where, again, you have to recognize that the buyer wants to mitigate the risk. Conversely, the seller wants to maximize the value. How do we get there? And we get there through structure. We get there through recognizing the buyer risks that they're taking and accommodating that risk, but finding other ways to maximize value. Customer concentration. I mean, this is a big one. Sellers' customer issues. So I'm in the middle of one right now, and it's not customer concentration, it is longevity of customers. So in this case, this guy had, he's like, look, all these guys have been with me for 30 years. And he's trying to sell to, this happens to be an insurance company. He's trying to sell to a young guy that's 30, 35 years old. And he's sitting there, this guy's saying, well, what's the likelihood they're going to continue to work with me? Well, that's the tough one. So we're always talking about customer concentration, and that is a huge risk. But now we have to look at the composition of the customer and the likelihood of transfer. It's not just how much of one customer. Now it's what is the composition of the customer, because that obviously affects value that you have, especially when you're talking personal interaction, seller interaction with the customer. That's a big challenge because the buyer is not, it's hard for them to embrace that this is just a matter of the service I provide as opposed to the relationship the seller and the customer have. Landlord issues. This one's is a doozy, and most sellers don't know it. So what happens is that if you don't own your real estate and you're leasing space, there is zero motivation for the landlord to take you off of that lease. And this is where the sellers are like, what do you mean? Well, when I say that, buyer qualifies for the lease, seller's like, all right, I'll make the assignment and I'm going to take a personal guarantee from the buyer. But if I go through, he defaults, I'm coming after you. And then the seller's like, the risk associated with that is considerable. And, we talk to our sellers and there's just no motivation for the landlords to do that. So when do we talk to them? Well, once we have a deal, then we can talk about the merits of structuring a new lease. But I can tell you that 9 times out of 10, the landlord, there's just no motivation for them to do it, and they won't. Family issues. I'm in the middle of this one too. So in this case, wife wants to sell, husband doesn't want to sell. Husband is showing up at our doorstep, going through the motions, and and his wife is under the assumption that they're getting ready to sell the company. And I can tell you that this guy has little to no motivation to sell the company. And it's something else. So the family, again, so that's one with spouses. The second one, and we bumped into this a couple weeks ago, where all of a sudden we're going to market. This seller hadn't even considered giving it or selling it to his kid. And so, he just it didn't even cross his mind. Why would my son, in this case, want to work this hard like his old man did? And that's the guy. That was the exact words the guy said. I said, well, I don't know, but you definitely want to have that conversation before you get into this process. And so, as it would be, his kid wanted the business. So again, family issues will tend to scuttle deals. So settle those before you get into the sale process. If not, that'll certainly be a deal killer. Liens. Our standard practice is we run lien searches all before we even get into this, because we just find liens. And sometimes they don't make a lick of difference because it's been paid off. Someone just forgot to remove the lien. Other times it's like, oh man, I had no idea that was there. So what happens is, and for those of you who don't know, I mean, typically in an asset sale, you have to provide clear title to the assets you're selling. And in this case, it has to do with awareness. They just didn't know that it wasn't there or that it was in place. And so you just want to know. And for those of you that are here in Indiana, you just go to the Secretary of State, go to, I believe it's online services, online business services, and then to UCC. Then you can do a search on your own company and see what's there. Next is the risk and reward. And again, that's all the deal killers are about risk. The comfort that a buyer has to have in order to buy the company. It doesn't matter if they're professional buyers or they're individual buyers. There is inherent risk associated with buying a company. And the work we do in advance mitigates that. We're trying to understand the buyers or the sellers, what the seller's situation is, not only just financially, but emotionally, and what are going to be the speed bumps that we're going to experience. And so as sellers or advisors to sellers, you have to be in a position to advise, understand what it is that you're selling, and understand the risk associated with it, because that will be the ultimate deal killer. There are too many opportunities for business buyers to park their money elsewhere and get a reasonable return, especially in today's prevailing economic conditions. So helping a buyer understand what it is that they are acquiring and how they can pay back and get the return of their investment and on their investment, that is where this risk and reward comes from. Next is risk assessment. And these are all basic things that we go through in evaluating a company. What I would tell you from an appraisal and exit planning standpoint, I would tell you that we have a self-assessment tool that it's complimentary. There is no cost whatsoever for you as the business owner or you that want to send it to your client. We use what's called the Value Builder system. And this is a self-assessment. And the reason we use it, and in full disclosure, I sit on their international board, but the reason we use it is so it helps start the discussion of these risk characteristics. And it makes a business owner think about, I never looked at my business through the eyes of a buyer. And so I would encourage you, and you can go to valuebuilders.us. We'll have a link to everything in the post broadcast email. Certainly one thing we absolutely advocate for. All right, I have a couple questions, or I have one question right now. The question is how to manage expectations of the seller when the letter of intent says one thing, but the purchase agreement infers another. Okay, so what we've done, and we started this about 30 years ago, is we engage an escrow attorney. And so buyer submits a letter of intent, seller, we negotiate it back, and it's just the framework. I mean, it's not like a home where it's a binding contract. This is the framework of a deal. And what we do is we take that and we give it to our escrow attorney. Escrow attorney represents no one, and they formalize in legal terms. We then take that document and we give it to the buyer and seller attorney. And then they can put their touches on it. And the reason we do that is historically, if it goes to the buyer's attorney, the attorney undoubtedly will advocate for their buyer, and they should. And it's all skewed that way. Then it goes back to the seller, and then that seller's attorney does the same thing. So they advocate for their client, and it gets skewed their way. And the problem we run into is that the only one that makes any money are the attorneys. So we're eating up all proceeds. The buyer's having to incur additional costs. Same thing with the seller. Seller's eating into their net. And when in fact we use this escrow attorney, and we have found that it has saved, at least half half the legal expense. So how do you manage the expectation? First thing is, and the reason I share that is because letter of intent, it happens normally when it gets formalized. The offer comes formalized in the purchase and sale agreement. So that I hope that answers your question. I mean, we're trying to, the framework of the letter of intent should be reasonably consistent with that of the purchase and sale agreement. Okay. Any other questions? I think I'm good. So, next steps. So like I was telling you, value builder assessment, you're welcome to do that. You can email me at any time. One of the beauties of our shop here, I mean, we haven't been doing this for 40 years, not having an open shop. So if you have a question or you just want to talk through something, we've got 17 people up here that would be more than happy to talk through this. And I'll let you know when we have to turn the meter on. And then lastly, we have a podcast. It's called Defenders of Business Value. We talk about all things value, what builds value, preserves value, and transfers value. So it seems to be resonating with a number of folks. So hopefully you can join us on that. We'll get the date of our next session out for next month. I believe it's the 19th. Don't hold me to that. I had an opportunity to speak at the Butler Disruption Conference earlier this month, and we may tailor that. And what the disruption that we talked about are things that disrupt value in a business: divorce, death, disability, and the like. So we're probably going to do something like that. So if there's no additional questions, I just want to thank you for your attention. I know your time is valuable, and hopefully that you found our time together meaningful. So if you need anything, again, give us a call. We're happy to help. Thanks so much.
Thank you for joining the Defenders of Business Value podcast. If you're preparing your business for sale, visit LegacyTransitionAdvisors.com or text EXIT to 35893 to begin your journey to maximum saleable value. If you want more episodes packed with strategies to transfer maximum value in your business, visit DefendersOfBusinessValue.com. Better yet, subscribe now so you don't miss the future episodes. This program is copyright Legacy Transition Advisors, LLC. All rights reserved.